Housing data weak, job data schizophrenic, manufacturing data bad, economy not doing great. Really confusing economy going into the summer. A lot of doldrums in the financial markets as people pull money out, not only out of gold, silver, but Bitcoin, stocks, and bonds, and all that. Hey everybody, this is Rob Kientz with GoldSilverPros.com. I'm your host for the weekly market wrap. It is July 7th, 2023, and we're doing a first weekly market wrap in the last couple of weeks due to the holiday. It's summertime. There's not a whole lot going on in the financial sector, although we do tend to get a little bit of news, and that's what we'll be talking about today. I wanted to start off with what's going on in the economic environment. We're going to start with employment. First week of the month, typically you get your employment reports. It leads off on that Wednesday with the ADP employment report, which ADP is the largest private payroll processor here in the United States. And then you get the government's BLS non-farm payrolls. Those reports aren't agreeing with each other. The BLS is giving 209,000 jobs created on expectation of 240. Certainly not the rosy picture we would have liked, and certainly a lot less than the 306,000 jobs created last month. Of course, they always seasonally reduce those down, so the numbers are never correct on the BLS anyway. But the fact that the original print this month for the BLS is so low on expectations of a much higher number indicates that the job situation is not too great according to the government. When you look at ADP, the private company that runs payroll for a lot of companies across the U.S. and certainly has access to a lot of data, they recently revised their methodology and their numbers have been a little bit higher on average. This month, almost 500,000 jobs created on expectations of 220. That's such a blowout print. You look at it and have to say, where are they getting their data? Because no other employment data in the economy is pointing to the fact that we would have created 500,000 jobs. And so I've got to question that report. And the thing about unemployment is ADP and the BLS reports have always been different. The ADP used to be more conservative than the BLS. Now I would consider the BLS slightly more conservative than ADP. So I don't like the methodology for either one. Their statistic methodology and sampling methodology is not great. I don't appreciate them, to be honest with you, but there you have the numbers. Going into housing, we have a lot of new home sales kicking off, but the permits are falling apart. So it seems to indicate that people are applying for new homes, but they're not able to get through the permitting process. Is that a financial issue, or the local counties just giving people a hard time on new builds? I don't know, but it seems as though the real estate market is trying to grow and it's not. Now you would expect real estate to do very well in the summer because it's summertime. That's when the majority of homes are sold, when most people move because the kids are out of school. It's just simply easier when you got 3 months to plan all that. But even though that is the case, the home sales have not been super robust. I'm not looking at this as if we have a housing market recovery. We've got differing data points which point to the fact that a lot of people want housing and they can't get it, which to me points to a credit problem. Overall job openings fell from 10.3 million to 9.8 million. And overall, the unemployment rate is 3.6%. Hourly wages went up 0.4%. That's not keeping up with CPI, which is the only thing that really matters, because if not keeping up with inflation, it doesn't matter. But at least it was a positive. Moving over to the stock market, the S&P has risen on Friday as traders are shaking off the fear that the Fed will resume raising rates, which they're going to. We know they're going to. I don't know why that's a question. Powell's already stated what they're going to do. So unless they change it. Overall, looking at the cryptocurrency complex, Bitcoin is down $97 today to 30,196. As we look at Ethereum, it's down $26 to 1861.29. Litecoin is down 71 cents to 97.12. XRP is unchanged at 47 cents. That's up about 5 cents from a few weeks ago. So they're doing okay. Dogecoin is at 7% unchanged. Not a big surprise there. Cardano unchanged at 28 cents, and so on and so forth. We have the rest of the cryptos. Cryptos are doing okay. They've been up lately. I remember Bitcoin falling from 60 to 20,000 roughly, getting up to 26, then back down and back up to 30. So it looks like Bitcoin is on its rise up. So I expect as we get back into the fall and people start putting their money back into financial investments, that Bitcoin along with gold and silver are going to get bids. I think that's what's going to happen. On the bond market front, it's really interesting. We still have about half of the bond market complex above 5%. Everything 1 year or less in terms of duration on the U.S. Treasury market is over 5%. The U.S. 1 year is almost 5.5. It's 5.424. The 6 months even higher. It's inverted from the 1 year at 5.493. The U.S. 4 month is 5.44. The 3 month is 5.385, and so on and so forth. The benchmark 2 years just under 5% at 4.94, and the 10 years at 4.058. We still have a massive yield curve inversion, which means that the shorter term issuance treasuries are demanding more premium because they see more short term risk, which is generally indicative of a recession. Going to the news for the week, as I mentioned, record number of car buyers with $1,000 payments, people swimming in debt. Consumers, according to the article, are taking on too much auto debt, which could have disastrous consequences during the next economic downturn. Edmunds, which is the famous car mag and review site, second quarter vehicle transaction data shows that 17.1% of consumers who financed a new car signed on for four-figure monthly payments. This now stands at a record high, up from 12.2% a year earlier. Before COVID, the figure was around 4.3. So we're 4 times higher than pre-COVID on people taking expensive cars, $1,000 payment or more. Now, inflation certainly has something to do with this. Everything's getting more expensive. So more cars are going to start to fall into that $1,000 range, although you can get most regular passenger cars and trucks for less than $1,000, depending on what you buy. But the fact that more people are taking on the luxury $1,000 payment above on their car payments indicates that people are spending beyond their means. Average monthly payments, according to the article, also reached a new high of $733. So not only are people taking on more expensive car payments, but across the board, people are paying more for cars. That compares with $730 in the first quarter and $678 in the second quarter of 2022. That's a year over year. The payments have gone up over $50, the average payment for cars. Buyers were financed with an average APR of around 7.1%, the highest since the fourth quarter of 2007. That would be 16 years ago and before the financial crisis. Let's say that again. The APR, average APR of a car sold in the U.S. right now is 7.1%, highest since the fourth quarter of 2007, right before the big crash. Does this indicate to you what may be going on in the economy, ladies and gentlemen? Moving on to the second story of the week of note. French cops, according to Zero Hedge, can now secretly activate phone cameras, microphones, and GPS units to spy on citizens. According to the article, cops in France have been granted the authority to remotely activate a suspect's cell phone camera, microphone, and GPS after the passage of the provision, a wider justice reform bill on Wednesday night. That means this becomes a spying device in France, and you have to wonder if U.S. authorities and other European authorities and other Western world authorities can do this without official approval. Be careful with your phones. Be careful with your phones, because they could be spy devices if similar laws are passed in your jurisdiction. According to the article, the bill passed in France allows the geolocation of crime suspects, covering other devices like laptops, cars, and connected devices, just as it could be remotely activated to record sound and images of people suspected of terror offenses, as well as delinquency of organized crime, according to the French People's Gazette. According to French digital rights advocacy group La Quadrature du Net, the provisions raise serious concerns over infringement of fundamental liberties and violate the right to security, right to a private life, and to private correspondence, and the right to come and go freely. The group called it part of a slide into heavy-handed security. Lawmakers defended the move, with Justice Minister Eric Dupont-Moretti insisting that the bill would apply to dozens of cases a year, with members of parliament inserted an amendment which allows the remote spying when justified by nature and seriousness of the crime. I don't know how you can limit several hundred people when the remit or the acceptance criteria for turning that on is so loosely defined and very vague. It seems like to me this could be abused, but at the end of the day, we'll have to see what's going to go on in France. I wanted to take a moment to get into the charting and the trade of the gold and silver market so you guys know what's going on. This is the beefy part of the presentation where we put on the visual aids. Here, Gold Charts Are Us. We have a little chart where you can see that gold has come down below its 15-200-day moving average, which means we're in a little bit of a bear market. That doesn't mean we're in a long-term bear market, but it just means that prices have fallen below the last 15-200-day trends, meaning that traders are a little soft in gold and silver. Now, that's normal for the summer. Now, how far it falls, we'll have to see. I've been an advocate that the news cycle this time in the summer will keep gold and silver up at least a little bit, but the downside price targets for gold are really in that, I would say, 1650 to 1750 price range. 1750 is probably the ideal bottom, and then silver is probably down to 17 to 18 bucks. Do I expect them to go down that far this summer? No, because of the news cycle, but it's possible that they might, and you can certainly see that here on the chart. Moving over to the gold depository information, you can see overall in the last 4 weeks between London and the U.S., 2.3 million ounces of gold net have been taken out of all the coffers. You can see quite a bit, about 900,000 net has been taken off of the company. I'm sorry, 500,000 total. And then all this red on the ETFs, most of which are stored in London. So gold is being taken off of London and COMEX Western markets as we speak. Silver is being put back on to the tune of 3 million ounces over the last 4 months. Most of that in COMEX. COMEX has received a huge infusion of silver over the last couple of weeks to bring the overall movement in silver on the COMEX green positive, meaning you're going to see more in the COMEX. So as we look at the total amount of COMEX and click on that chart, sorry, went the wrong place there. Click there and we get this chart. You can see there's been a slight uptick. Now it's not a huge uptick in total silver ounces held. So it's not like we're replenishing vast amounts of inventory that have been sold off the COMEX the last 2 years. It's only a little blip, which is why I show this chart, baby blip. But the fact that some is coming back on means that we have some weekends trying to get rid of their gold and silver. And that's normal in a market which sideways trades. Some people are going to capitulate and sell out, but it's not a large amount, so I'm not too worried about it. Looking at the gold futures chart here at the COMEX, this is yesterday's data. The dominant contract month, and I say dominant contract month, it's my term for saying where the price is really determined because that's where most of the trading is in August. That will eventually rotate over here to December and maybe a little bit to a lesser degree to October. December will be the next big month after August. But August has a bunch of trading, and you can see that they had 391 deliveries for the July contract, only 372 contracts left. So if you want to get physical, you're going to do EFP. There were 2,854 EFP contracts. What that column signifies is when people take a contract for gold or silver on the COMEX and they go to London and either just try to trade the paper and take the difference in price and make a little money, or they try to get rid of their COMEX position and get physical delivered. We don't know what they're doing. Those are all private terms. We'll never know. But just the fact that this number is so high, how much higher this year than it's been in recent memory, means that people are looking for the physical. And I talked with Andy Scheckman, who runs Miles Franklin, and he said he's been getting a lot of feedback that the EFPs are exploding and that there was over something like 1.1 billion ounces run through the EFPs in the last calendar year for gold and silver, which would not surprise me. It basically means that people, in a nutshell, it means that people in the US are not getting enough gold and silver through the COMEX, that they're having to reach out to other markets. In a nutshell, that's what that means. And that's the interesting point of it. We can see as far as early trading data here on Friday, as of, what time was that? As of probably, about 1:32, so about an hour ago. You can see gold's trading up about 17 bucks on the day. The dominant contract, 199,000 closed today so far. 200,000 contracts already in half a day. This is why you know it's not physical, it's all paper. Because they're not going to settle 200,000 contracts in physical delivery. You know how I know that? Because you go to the chart and they only did this month 391, 391. What percentage is 391 out of 200,000? It's nothing. So you have less than 1/100% of deliveries. The rest is just paper speculative trading. It doesn't mean jack squat in terms of the actual value of gold and silver. But in any case, we look at it up 17 bucks today. Other than that, doesn't mean anything. So I'm going to move on. Looking at silver, relatively, okay trade for silver at summertime. People are dumping contracts in both gold and silver. We'll see that on the commitment traders report here in a moment. For silver, it's September is the contract, 103 contracts out, 103,000 contracts open interest. You had 474 EFPs over to London, 96 deliveries on the July contract. Let's look back a day on Wednesday's trading data. You have 477 EFPs of 5,000 ounce silver contract, and you have 341 actual deliveries. People want the physical. You can tell it in the charts. It's blatantly obvious. Looking at the dominant contract month right now, you'd have to say it's September because I had 46,000 contracts closing so far today, about halfway through the day, up 40 cents to 23.28. If you look at yesterday's data, we had a total of 61,000 contracts closed for silver, down 51 cents. So it's up and it's down a little, but it hasn't crashed, which is the important part. Looking at the commitment of traders report, this is where the regular, the CFTC, reports on the traders positioning in bulk or in aggregate form across the market. So they'll break it into groups. You got your producer merchants. Producers are like Samsung that need it for the mobile phones, or anybody that needs it for electronics or for medicine or whatever silver's used for, the military. The producers are the ones that make it. They're the miners, or they're the scrappers. Those are the ones that produce it. So that's that category. Swap dealers are the bullion banks. They're the big money that moves the market around. Managed money, or the financial types, they have a lot of money. They don't put a lot in gold and silver. They tend to be the dumbest trader in terms of what's going on. So they're usually the ones that take it in the shorts. And they have deep pockets because managed money represents all the money floating around the stock market. Only a small percentage comes in gold and silver. So if they lose money here, it doesn't really affect them all that much. And so they tend to be, you know, the dumb money here because I guess they have less to lose than everybody else. The other reportables are like wealthy individuals, family offices. Looking at the data, the biggest single data point, there's two big data points here I want to emphasize. The swap dealers have dropped almost 6,000 short contracts in silver, meaning net they've gone long because they've reduced their short exposure. What does that mean? When you put a contract out on a futures market, you're saying, you know, for the next big month, September, I believe, for silver, I want to go short. I'm going below the current price. The other person taking that trade thinks it's going long. They think the price is going up. So he's going to take that and say, yeah, I'm going long. And you battle out to see who makes money. If the price goes negative, it goes down. The guy that has the short makes money on the trade. He gets money at the end of the day, minus his commissions. If it goes up, the guy that was long makes the money. So the bullion dealers, the swap dealers, are betting against the rest of the market going long. They've added A64 longs. They dropped 5,800 shorts, a net position change of 6,600 contracts to the north side. And there's only 40,000 contracts. That's a huge percentage. That's what? Over 10%. It's about 15% of contracts in 1 week where the bullion dealers made a big change. The other big change is the managed money is just dumping out of silver, period. They dropped longs and they dropped shorts and they said, get us the hell out of this trade. It looks like the managed money is just tired of silver. The question will be, will the bullion banks, if managed money and no longer has an appetite to play the silver market, will the swap dealers and bullion banks have a way to affect their short position covering on the silver market? If managed money and other reportables just stop trading, then it could cause problems for the bullion banks who need those guys to be their foil or to be the opposite of their trade. We'll pay attention to that market as it goes along. Coming down to gold, it's another same thing. Swap dealers dropped 10,000 contracts. One of the reasons why I'm bullish on both gold and silver this summer is because even though gold and silver tend to fail this summer, and a lot of the financial markets do, because everybody puts away their books and goes on their summer vacations and spends money on their homes and doesn't invest, the bullion banks in both gold and silver are dropping shorts like mad. They're preparing for a world in which both gold and silver go ape stuff to the upside. Let me say that again. These swap dealers, the smart money in the precious metals futures markets, in the past week have made bold moves to go long in their interest in the gold and silver market, which seems to indicate they think that gold and silver aren't going to crash this summer because they wouldn't have gotten rid of the shorts if they had. If they thought they were going to crash, they would have increased their shorts, because as that price crashes, those short positions come into the money and make them money. They're saying despite what normally happens during the summer, we're dropping potential millions of dollars of profit, hundreds of thousands of millions, because we think it's going to be long. Don't take this to be insignificant. When the bullion dealers make a move like this in both gold and in silver, that's something that you must absolutely pay attention to. It doesn't mean that they're going to launch forward this summer, but it means a lot of that selling pressure has been reduced because the swap dealers are the ones that apply a lot of it. And it means that the market's a little softer now. We don't expect a big plunge in gold and silver. Maybe there's a modest plunge. I'm not expecting them to hit big unless the swap dealers switch their positions. The other reportables, the wealthy families, are just dropping positions right and left, but they're dropping their longs. Net, they expect silver to go a little bit short here to be soft. Everybody's dropping. They dropped the open interest on the market of 6,000 contracts. So again, during the summer, less trade here in gold and silver, people dropping contracts. But the important thing to note, the biggest data points are swap dealers are going net long in both gold and silver. That's what we want to know. Here's the London Vault data. You look over here and gold's held steady. Not a lot's coming off. Silver is basically held steady. A lot came off here. A little bit of a little nascent recovery. Same thing going on in COMEX. A little bit of silver coming back in. Weekend selling it back in. It's okay. But they're not moving in the market. So we're still low on inventories in both LBMA and COMEX. Here is the China data at the Shanghai Gold Exchange. And when you go to the monthly report, you can see what's going on. The two charts I wanted to show you are that year on year, we've had less gold and silver change hands on the Shanghai than we had. It's down 54%. That is significant. Month to month, down 6%. So the trend is actually slightly up, but over the last year, a little bit less trade. But that doesn't mean it's insignificant, because this table is what we really want. And you can see the actual delivery ratio for gold and silver, almost 70% for gold in the last month, 12% for silver. For the year, over 73% for gold, 17% for silver. So there's more physical delivered in Shanghai than any other major market in the world. Shanghai has the better prices, and right now gold is priced at about $45, $44 higher in China than it is the US, which means there's the opportunity for gold and silver to go up. when you get more physical trade data in there. All right, to summarize, housing data weak, job data schizophrenic, manufacturing data bad, economy not doing great, really confusing economy going into the summer. A lot of doldrums in the financial markets as people pull money out, not only out of gold, silver, but Bitcoin, stocks, and bonds and all that. Bond market is screaming recession coming up. Economic fundamentals are not strong. They're a bit schizophrenic and volatile, which is normal before a recession. We're going to have to see what the Fed does, what Powell says, and what he says as a chairman, what the other members say about what they're going to do. We expect more rate hikes coming. They did a temporary little reprieve, which makes sense during the summer because you can do a reprieve during the summer and the effects of that reprieve are muted because there are less people in the market. So if you're going to stop a direction, like if you're raising and you want to stop, doing it during the summer is great because it's going to have a muted effect. If you're lowering rates and you want to stop, doing it during the summer is going to have a better effect because the markets just aren't as frothy as they are from fall to spring when more people are trading. So the Fed did the right thing in announcing the timing, but we see when we come back in the next couple of months, as we edge toward fall and the summer gets a little long on the tooth and we start getting the cooler weather and the leaves change, is the Fed going to come back and start raising rates again? If we do, I suggest that we will immediately within a month or two go into a recession. So I'm predicting during the second half of 2023 that we hit the official recession, at least in terms of GDP numbers. The government may not call it. I don't really care. If the GDP goes negative, then that means that we're in a recession. Overall, the number's not looking too good, but gold and silver are holding up, which is positive. We like that. And we're going to continue to follow all of this. Stay right here on this channel as we continue to follow as we go along right here on goldsilverpros.com. Thank you so much for tuning in. This has been Rob Kientz, your host. Stay tuned to the channel. We got more content coming. Don't click off. There's lots of stuff down there for you. Until next time, Rob Kientz, Gold Silver Pros. Have a great weekend.